Hello, everyone. Thank you for joining us today and welcome to our webinar on self-employment tax with JC Hobbs, the Associate Extension Specialist from Oklahoma State University. I am Sarah Campbell. I'm USDA's Beginning Farmer and Rancher Coordinator, so I work on beginning farmer and rancher issues across the department, including those startup business aches and growing pains. And we know that taxes is an issue that is of interest to a lot of producers, and in particular self-employment tax. So we have USDA is sponsoring an initiative. We're calling it the Farm Tax and Asset Protection Initiative, and we are working with tax experts from across the country to bring educational materials and resources to farmers and ranchers across the country. You can learn more at farmers.gov/taxes or at ruraltax.org. So keep checking those websites. We've got webinars almost every month, and then a whole bunch of other great materials, including sample tax returns and, flyers and kind of one-pagers or two-pagers on different tax rules and USDA programs. So we've just got a robust suite of resources for folks, and we encourage you to check those out and explore them. Today's webinar is being recorded, so if you have questions, please put them in the Q&A. Janet Wright and I will be moderating the Q&A, and we will let Jesse know when we've got questions in there to answer. But today's webinar is being recorded. It will be posted online along with the slides and any supplemental materials. It just takes us a little bit of time to caption those webinars and then get them posted on farmers.gov. So it takes us 1 to 2 weeks usually to kind of turn that around. So anybody who's registered for the webinar should expect an email in a couple of weeks, just letting you know that all those things are online and directing you to them with the appropriate links. So don't worry if you think you've missed something or you haven't found the slides online. It's all coming. We just tend to package it together and it takes us a little bit of time. So without further ado, I'm going to hand it over to JC.
Thanks, Sarah. Well, as mentioned, we'll be talking about self-employment taxes today and all the ins and outs, why you want to pay, how it works, and all of that. As you stated, we're part of the Rural Tax Education Group. I've been a member of that since 2011. And our goal is to provide income tax material, educational materials, etc., for farmers, ranchers, landowners, timber folks, etc. Our purpose, or what we've got, is we're working with USDA. We've got an agreement. And as part of this, we are providing this tax information. Again, it is information and education, not providing information concerning tax return preparation, concerning how to best apply it to your situation. It is simply educational purposes, trying to allow you to have an understanding of what's there, how it applies, and the questions you need to ask when it comes down to tax preparation and time, and how to work with your tax preparer for planning purposes as well. Let's jump into self-employment. Self-employment taxes is based upon self-employment income. That's being earned income from a trade or business. So it can be a farm business, a non-farm business. It can also be services provided. So if you're not necessarily a true farm business, but you do custom work for others, and then that service you're providing is subject, or the income from that is subject to self-employment tax. Rental income, farmers often rent property to others, especially when we get to retirement years. Rental income, if that farmer is still participating in that operation, it is considered self-employment income. So we're looking at a crop share arrangement where the farmer is actually participating. It's called material participation in the production of those crops or livestock. And that means more than just putting money into it. You're making decisions, etc. So self-employment tax is kind of a unique computation. What you've got is it's based upon your total net farm income, And it's 92.35% of that is subject to SE tax. The self-employment tax rate's 15.3%. It's pretty much fixed, or it is fixed. It's made up of two parts. The Social Security portion is at 12.4%. So of that 15.3, 12.4 is Social Security. So, it does cap out. So at $147,000 or more of earnings, you maximize the amount of self-employment tax for Social Security purposes you pay. Now, Medicare, it's 2.9%, but its earnings, it's not capped. So if you made $1 million net farm income, well, you're going to pay 2.9% on that total amount. Now, there's also an additional Medicare tax. Excuse me. It's on net self-employment earnings in excess of $250,000 if you're married filing joint in your tax return. So you're married filing a joint return, you pay another 0.9% on top of that, up above the 2.5 million, or 250,000 rather, I'm sorry. And if you're single, it's 200,000. One thing about the other side of the coin, if profit or net farm income less than $400, no self-employment taxes due. So if it's on the bottom end, no SE tax. Upper end, like I said, it gets capped at 147,000 for Social Security purposes. Now, one thing that does apply and is allowed for farmers, other small business, 1/2 of the self-employment tax owed is allowed as a deduction on the front of the 1040. So what happens is, so you pay, as an example, pay $30,000 of SE tax, and you're allowed a deduction for 15,000 of that against your income that was taxable. So you do get some tax break from the amount of self-employment tax paid up to 1/2 of that amount. So here's an example of a computation for how we come up with those numbers. Now remember that 147,000 limit. So here in the first one, we got $100,000 of net farm income. So we're below the limit. 100,000 times 92.35% multiplied then by 15.3% gives us a total SE tax due of $14,130. The net farm income, if it's above the 147,000, well, it caps out. So we only pay SE tax, or Social Security tax on 147. Again, multiplied, put that 0.9235%, gives us 135,755. This time we multiply it by 12.4, so we get $16,834 of Social Security. That's the portion that goes for Social Security portion, rather. The full amount, 150,000, since there's no cap for Medicare, is subject to the 92.35, so it's 138,525. Multiplied by its rate of 2.9, so we get 4,017 of Medicare. Add those two numbers together, we pay total SE tax in this scenario of $21,251. So that kind of gives you an idea of how it breaks down and why we see that there's two parts and why one is capped and one isn't. Now, if you have farm employees, you operate the farm. Now, the SE tax is on the self-employed person. That'd be the farm operator. But if you have farm employees as well, then those farm employees are also subject to Social Security and Medicare tax on their cash wages paid. And their portion is 7.35%, so half. The employer also has to pay in for the employee. So his portion, or the employer's portion, is 7.35. There, you add those two together, we get the 15% total. So you look at those two numbers, it applies for farm employees versus self-employed at the same percentage. And here we can kind of lay out why that half of that is deductible on the farm return as a self-employed. For the purposes of the employee wages are withheld to the point of 7.35. The employer kicks in the remainder. So we're just trying to even it out between the farm employee versus the self-employed operator. Now there's two tests to see whether cash wages are subject to SE tax for current rules. $150 or more of cash wages paid to an employee, then you got to withhold Social Security and Medicare. Or if you've got more than one employee, $2,500 or more of total wages paid to all of them. So you've got to look at, is it an individual, a single employee, or do we have a lot? And those are the two numbers we play with. And that second one, so if you've got $2,500 or more of total wages paid, and you've got some employees that you're only paying $100, you still have to withhold 100% or pay in Social Security on even that $100. They're not exempt. So the rules are looking at the amounts for those two. Often get questions concerning the family farmer. They employ family members, employ their children. Are those children going to be subject to the Social Security payments? Well, if a child works for you in your trade or business and they are under the age of 18 years old, those children are not subject to either Social Security or Medicare taxes. So under the age of 18, subject to neither. Once they reach 18 or older, they are subject to both. Now, spouses, if they work for you on that same farm, doesn't matter, they're going to be subject to both Social Security and Medicare taxes. Now, farm operators are exempt from paying federal unemployment tax for child employees and spouses. So family employees are not subject to the federal unemployment tax. That's FUTA, for those that want to know what the acronym is. Neither are subject to that. So why should we want to pay self-employment tax? It's very important. What we often see is for smaller farm businesses, the self-employment tax bill is often larger than the income tax amount that would be due, simply because the self-employment tax rate is 15.3%. It's on the total amount of net farm income. There's no deductions against that for exemptions, other items off the front of the 1040. So you're going to pay a tax on 15.3. Then you move that and that income to the configure tax adjusted gross income, and we come up to taxable income. Our individual income tax rates start at 10, 12, 22, and 24. So a lot of times the self-employment tax is a much heftier amount of money paid in than the income tax. But we want to pay it. Here's why. It provides three benefits: retirement, those are also considered old age benefits; survivor benefits, so if something happens to you, the surviving spouse receives benefits, and it also provides their disability insurance if the primary operator becomes disabled. So it covers disability in case he can't work, or she; survivor benefits if the primary operator is deceased; and retirement when we get to the point of wanting to quit farming or quit ranching, etc. Now, the rules state you have to pay in a certain amount of what they refer to as quarters of coverage to receive benefits. And those quarters of coverage are basically discussed as work tests. There's two tests that the Social Security Administration looks at before they will start making payments to an individual, either under the old age, the disability, or survivor benefits. So you have to meet the recent work test and the duration of work test to qualify for benefits for disability and survivor. So the recent work test, like I said, the disability and survivor benefits. Duration of work test looks at retirement benefits. And again, they're based upon a number of credits earned. And credits are based upon the amount of income subject to tax each year. So you get a credit or 4 credits per year max. If you look at that for 2022, For every $1,510 of net earnings, an individual will reap 1/4 or 1 credit. So it takes a total of $6,040 of earnings to get 4 credits for the year. So you don't necessarily always have to earn 4, but you really definitely want to get at least 1 per year. So if you look at Social Security, disability, survivor benefits, the recent work test, and it's also based upon age. If you're 31 years of age or older, you have to have 20 credits. 20 credits basically comes back to you have to have 5 years of work. So you've got to be paid in for 20 credits. That'd be 4 credits for each of 5 years. If you're younger than 31, it looks at the number of years of work. 1.5 years of work is required during a 3-year period. So you have to work 3 years, have to be involved in the operation 3 years, and you have to have 1.5 years of work in that 3-year period. That gets you those two where you could qualify for the recent work test. Now, the duration of work test, same kind of requirement based upon age. If you're 27 and younger, 1.5 years of work required. If you're 62 and older, you have to have worked 10 years and receive 40 credits. Now, if you're reaching the age of retirement and we start looking back with Social Security and they start doing a credit check and see what your amount would be that you're allowed, it doesn't necessarily require that you have 10 consecutive years of work test credits. You have to have a total of 10 years over the period that you've been involved in the farm. So if you started farming at the age of, say, you're 22 to make life simple, so 40 years, you have to have 10 credits for that 40-year period, or 10 years of work, 40 credits for that period. If you're age 28 to 62, those credit amounts vary. And depending upon what all's going on there, you're going to have to go to the Social Security Administration to have them help you do the calculations because it's based upon formulas. So what about, let's break it down even a little further. Social Security retirement benefits, 62 and older. Your benefit is based upon the 40 quarters of coverage, 40 credits. It looks at the largest amounts paid during those 40 quarters. So if you have years that are low income and you have years of greater income, they're going to throw out the lower numbers until they have to put them in to get 40 quarters of total coverage. If you've got zeros in there, those zeros can cause some problems, especially if you have a lot of 0 years. Again, you're looking at the largest amounts paid for that 40 quarters or that 10-year benefit history. Now, farmers, ranchers, often we have a situation where we have no self-employment tax being paid. We have losses or very little taxable income. This is not an uncommon problem. Now, if you're age 62, but you're less than the full retirement age. Full retirement age is right now is about 66 and 4 months, I believe. So you're 62, less than full retirement age. Your benefit that you calculate, it does get reduced depending upon your age at retirement. What does this mean? It simply states that farmers, and I'll show you in a moment how much that is, but what you end up doing is you have to wait to full retirement age to get full benefit. If you retire early, they do knock it back a little bit, but not a great amount. So why are farmers kind of at a loss here? Here's some agricultural issues. When I work with farmers and ranchers, the worst thing they see is paying taxes. Why? It means that they're not able to grow their business. They're paying taxes and they'd like to spend the money on other things. And I'll point those out in a moment. Another issue is income variability. Weather, prices, And prices becoming more of a world issue in the recent history of farmers. We used to be pretty much on our own. Now with world markets, depending upon what's going on worldwide in terms of wheat, corn, livestock production, supplies, etc., we have periods where prices are reduced. We have years of drought where we have low production. So we have low income years and years of farm losses. So we don't have money to reinvest in the business. We also like to invest in new and improved technologies that help us make more dollars. So what ends up happening? Well, we don't have enough money paid in to Social Security when we get ready to retire to have any retirement benefits or substantial retirement benefits enough to cover our needs in those retirement years. So it becomes critical to do some self-employment or Social Security planning, retirement planning. So what came about to help with this problem? So Congress, in many years ago, this was going back into about the 60s and 70s, they came up with the idea that farmers and other small business a lot of times have low income years. And they decided, well, they looked at farmers having a bigger problem than others. So they came up with what we call the optional method for paying self-employment taxes. So it's not necessarily based 100% on the net income. They give us some benefits of the doubt on some of those years and give us some ability when we have less income than what would get us full quarters of coverage to make some adjustments and pay in to get a quarter's worth of coverage or more. So again, what the purpose was, those benefits for paying the disability, survivor, retirement benefits. The idea was also, and has come to play in the last few years, it has a tendency to increase our taxable income, allows us to qualify for the earned income credit, the additional child care credit, child and dependency care credits, and also the self-employed health insurance deduction. So it becomes critical to think about using the optional method for paying SE tax, even when we have low income years, because the earned income credit is actually a refundable credit. What that means is if our income is below a certain threshold level, we will get a check from the US Treasury making up the difference. So it is very helpful. It provides income, cash flow, etc. The additional child tax credit basically reduces the amount of income tax that would be paid or due. So there's ways of using the optional method for paying self-employment tax to increase our disability, survivor, retirement benefits, while also increasing the ability either to reduce our income tax owed or to even get a check from the Treasury to help us in those low income years. So the farm optional method, it's basically a substitute used to calculate net earnings for self-employment taxes that doesn't necessarily follow all the rules from the net earnings as it shows up on the Schedule F, farm tax return. The retirement requirements, if your gross farm income is below $9,060 or $960 and less, then you're allowed to use the optional method. The net farm income compared to that gross farm income, net farm income must be less than $6,040, which is 2/3 of that upper number. Now remember earlier when I said 4 quarters of credit basically requires $6,040 of net farm income. So if net farm income is below that, then we're going to use this optional method where we can then pay in extra and get up to 4 quarters of coverage, even in a low income year or even years when we have negative net farm income. So it allows farmers and ranchers the ability to grow their coverage level even in years where we have little to no taxable income. So I've got an example here of gross farm, or how to calculate the farm optional method. There's two of these examples. The first one, we have income less than $9,060, but so the gross farm income in this example will be $6,000. We have a net loss. If we elect to use the optional method, we're going to get 2/3 of that $6,000 that we can use as earnings. So that's calculates out to $4,000. Remember, we're looking at 15.3%. So that $4,000 gets us we have to pay $612 into Social Security. We get 2/4 of coverage, because if you look at dividing the 4,000 by the 1510, that 1510 is what it takes to get 1/4 of coverage each quarter. So it goes in there twice. So you'd have $3,020 compared to the 4,000. We're going to get 2/4 of coverage in this example. So even though we have very little income, we're still getting 2/4 of coverage. Whereas if we did not use the farm optional method, we would have received 0. In this next example, we have more income, gross farm income, than the $960, but our net farm income is well below the 2/3 of that. So it's going to be below the $6,040. So we're allowed to use the optional method in this one. So we got 12,000 of gross farm income, 5,000 of net farm income. If we'd used the regular method of paying SE tax, we'd have paid in $706, and we received only 2/4 of coverage. Remember that 1510, it only gets us 3,000 in order to, we just don't get there. If we elect to use the optional method, the 60/40 as earnings gets us 4/4. So our self-employment tax in that scenario is only going to be about $220 more, but instead of just getting 2/4 of coverage, we are now going to get a total of 4. So what does it do? Well, it makes sure we qualify for retirement, disability, and survivor benefits if those quarters of coverage requirements are met. A lot of times, by using the farm optional method, we'll increase how fast we accumulate those quarters of coverage, so that if something happens to us at a younger age, we are covered for survivor and disability benefits. And it guarantees that we'll have retirement benefits at the end when we're ready to leave the farm. With the farm optional method, the way it's set up, it can be used as many times as needed. Other optional method for non-farmers, there's a limitation in the number of years that you can actually apply it and use it. Farmers, after realizing that we're subject to both low prices, weather, other conditions, world markets, there's no limit on the number of years that it can be used. So use it often, use it frequently, make sure you've got your quarters of coverage. It is important for you and your family. So what dictates full retirement age? So when can you retirement and receive the full retirement benefits? They're broken down into basically 3 time periods. If you're born in 1937 and earlier, you're reached full retirement age at 65. It's been fixed. If you're between 43 and 55, you reach full retirement age of 66. 1960 or later, you reach full retirement age of 67. Now you'll notice there's some breaks in there, 38 to 42. Well, what happens in those years is you increase the full retirement age by 2 months until you reach age 66. 56 to 60, same thing, or you add 2 months to each of those until you reach the age of 67. So those were the full retirement ages. That's how they break down, and that's when you receive full retirement benefits. So full retirement benefits, 65, 66, or 67 to make life simple. Now there's some earnings limits. And the reason they've done this is they've said, well, if you're going to retire and you still want to make money, still want to continue to operate, you're going to take some lumps In other words, losses of that income, your benefits rather, losses of your benefits, when your income, your taxable income gets above a certain level. So if you're under 14 or under full retirement age, you're say 62, and your income is above 19,560, for every $2 above that limit, you lose $1 of your Social Security benefit. Is this detrimental? Some operators say yes. If you're still going to continue to make money, it may be wise just to go ahead and wait until you reach full retirement age. If you reach full retirement age and you still want to work, which I've seen farmers want to do this, for every $3 over the limit, you lose $1. If you don't want that to happen, don't retire until you're age 70. At some point in time, there's no deduction whatsoever on that amount of income. It goes away. Most farmers that I work with, they never retire. So like I said, you can draw full retirement benefits 65, 66, or 67. With that, here's some references. The IRS publication 225, Farmer's Tax Guide, can be found on the irs.gov website. Simply search IRS publication 225. It's also on ruletax.org on our website there. It's the most recent copy. Also get some Social Security information just by going to ssa.gov. A lot of great information there. You just kind of have to weed your way through it, but it's very good. Then the ruletax.org website. This particular, there's 2 fact sheets, one written for just covering the self-employment tax side of things, and then the other one covering the optional method of paying SE tax. So you can look at either one or both, kind of get an idea of what's going on there. Here's my contact information. I failed to put my last name and my phone number. Did real good. J.C. Hobbs, phone number, if you got a pencil right quick. Before we put this on the website, I'll make sure it's, or when I send it to Sarah for publication. Phone number 580-237-7677. Email address is jc.hobbs@okstate.edu. I apologize for not getting that in there. My oversight. Are there questions?
There are. We've got a couple here. One is if the spouse, this is thus making, I'm guessing if it's like the income earning spouse dies and the first spouse is also no longer living and a second spouse and children from a second marriage are left to run the farm, what category do they fall in tax-wise?
Okay, making sure I've got all this. So the farm operator, his spouse is already deceased. He remarries. He remarries. So from a tax perspective, while him and his spouse are alive, they're going to be joint tenants and more than likely filing a joint income tax return. So married filing joint. Now, if he passes in the year, let's go use some dates here. So married filing joint, husband and wife, husband passes in 2022. She can still file as married filing joint for 2022, their last year as being married, even though he's deceased, but in 2023, she'll be filing as married or as a single individual. Now let's go into the Social Security side of this thing. More than likely when his first spouse deceased, he remarries, he should make sure that the Social Security Administration knows he's remarried, put his new spouse on the information for Social Security, then they would qualify for the disability or, survivor or retirement benefits. Hope that answered the question. If not, email your question to me, again, jc.hobbs@okstate.edu.
Thanks. We've got a couple more. On what form do you claim the form optional method? Is it on the form SE?
Yes, it's on. There's a separate portion of that comes off the Form SE, the SE tax form. And the comment was made, should that rate have been 7.65? And I think I had it 7.35. The rate should have been 7.65. I apologize. But yeah, the farm optional method is elected on the SE tax form.
Thanks. And we had one more question. I think it was from one of your earlier slides where you're giving an example with rates, and it asks if the rate should be 7.65.
That's correct. Glad somebody can do math better than I can. Should have been 7.65. That is correct. I apologize. I'll get that fixed as well. No other questions?
I'm telling folks, if you've got questions, go ahead and put them in there because we've got a little time. So if you've got them, throw them out there for discussion. And there will be more webinars. We do about one a month on taxes. So go to farmers.gov/taxes to sign up for future webinars and see what's being offered. And it looks like we got no more questions in the chat. Last call. All right, well, I think that was everything. Thanks everyone for joining. And like I said, this was being recorded. We'll get it posted it'll probably take us close to 2 weeks because we go in and caption them and edit them and then get them uploaded to YouTube in our farmers.gov playlist. And the slides and everything will also get posted. Anyone who's registered for this webinar, I'll get an email once all those materials are ready. Oh, here we go. We got a couple questions that came in. All right. So prior to being a rancher farmer, they have quarters. Do you need more recent quarters closer to retirement?
No, they do not. And they will be able to use those from the prior employment as well. They just have to meet the minimum number.
And then we've got a question here that says, are taxes just for those only Social Security age only?
That answer is no. Here's a situation. I'm working with a 4-H'er that has a 4-H project that is truly a trader business. He is 15 years old, and what he's doing is he's raising feeder pigs, and his feeder pig operation pretty good size. And he, like I said, he's 15. He has enough income annually to pay both income tax and self-employment tax. So no, it doesn't necessarily mean the tax of being on old enough. No, it doesn't matter.
One question was, does the tax information differ from state to state?
Federally on the SE tax, federal income tax, no. You've got to look at your state income tax, and those will vary. Some states have little or have no income tax. Other states have some. You just got to have to look at what state you're living in, and even in some areas, you may even have a local income tax. So what we're talking about here is on the federal side.
Thanks. Okay, and we've got one that's a little more complex here. If I set up a not-for-profit as an educational farming entity, would the tax status be as a nonprofit or farm entity? Can I be an employee if I'm funding the nonprofit?
I'm going to need a lot more information than what is given here. There's quite a few hurdles we're going to have to jump through to make sure that we set this thing up to as an educational item. And I want to make sure that I'm fully understanding what they're doing, because depending upon what they're wanting to accomplish, we may not be able to fund it as a nonprofit. So I need more information. I'd like to see them send me an email with their contact information, and I'd like to talk to them. That's deeper than what this subject, what we'll have time to discuss here.
Yes, that sounds like a good answer for me. Okay. And here's a question that I don't know is.
Okay, farm left to a non-farmer. This could be all kinds of interesting things. Here's a good scenario, and I'm going to use a family member in this. The dad dies and his daughter inherits the farm. She does not want to operate the farm, but she wants to keep it going. So she is now setting this thing up. She hires enough employees and farm managers, etc. All she does is oversee the operation, making sure that the work is done. They're doing all the work, all the management, etc. Then that person is a farm. Basically, we're filing the self-employment income. She's getting a salary, so she's paying as an employee. Yeah, there's all kinds of interesting little nuances there. It can be done. It depends upon what role that person that inherits or takes on the farm is doing. They could simply be an employee, or they could be an investor, and everything they receive is investment income and not subject to self-employment tax, just simply income tax. So depending upon what's going on there, there's a lot more information needed to go into a whole lot more detail for you, but it can work, and that can give you some ideas of how it would play into the tax rules.
Thanks, JC. Can we talk about backdating and filing an S-election? What types of information should be included on the form request?
This is another one we're going to have to know a lot more than just being for what we're talking about right now. I'd rather visit with them over the phone so that we can kind of get an idea of what's going on. Yeah, so it won't be rejected, definitely. Yeah. Have them contact me. Send me an email. Let's visit.
All right, well, it looks like we have cleared the deck. No more questions have come in. So I think we are good here. Well, thanks everyone for joining, and thanks JC for this important rundown, and I'm sure some folks are going to follow up with you. I sent a message to all the participants with your email address, so folks should be able to follow up there, and then we'll also email all of the participants once we have all the materials together.
Fantastic.
Well, thanks everyone, and have a great afternoon.